Welcome to Breaking News to Trading Moves. We are looking at a stack of information today detailing the recent activities of, well, one of the market's most followed investment houses, Berkshire Hathaway.
That's right. The core headline that everyone is reacting to is this new $4.3 billion stake Berkshire has established in Alphabet.
And that movement of capital, especially when paired with cuts to other major holdings, it sends a pretty clear signal.
It does. It tells you something about where some of the biggest long-term value players are looking for growth right now.
Absolutely. So our mission here is straightforward: to present the findings regarding this market signal and highlight the categories, companies, and tickers that observers immediately identified as, well, potential winners and losers. Okay, so let's start with the central action. We're talking about a $4.3 billion stake in Alphabet, ticker GOOGL.
Yeah, and the first takeaway is just the sheer size of it. This new position immediately places GOOGL in Berkshire's top 10 U.S. holdings. And that public endorsement, what people often call the Buffett seal of approval, that's really the primary takeaway here.
And crucially, this wasn't just money appearing out of thin air. The filing also showed that Berkshire was trimming other long-held positions.
Exactly, including Apple, ticker AAPL, and Bank of America, ticker BAC.
Which really sets the stage for where the money is flowing. We can see three main categories that seem to benefit from this move.
Yes, and they reflect a kind of validation of the current growth narratives in technology and high-quality companies.
So let's start with the first group. This one's the most obvious beneficiary, I think.
Mega cap AI and cloud platforms.
Right. The investment seems to validate the long-term cash flow and the whole AI story in these huge platforms.
It does, and that can attract more institutional capital. First, you have Alphabet, GOOGL, as the direct beneficiary of that $4.3 billion stake. That's a huge corporate validation.
And it doesn't just stop with Alphabet, does it? The thinking seems to be that this lifts the whole sector.
Precisely. Microsoft, MSFT, is often seen in the same light. It's another, dominant cloud and AI player that can benefit from these sector-wide capital flows into the mega cap AI leaders.
Okay, so category two. The market isn't just looking at tech. It seems to be reassessing other classic names because the Alphabet purchase reinforces that Berkshire still values strong brands with durable economic moats.
This is where you get the Buffett-style quality compounders.
And who falls into that bucket?
Well, first, there's Berkshire Hathaway itself, ticker BRK.BA.
So co-investing with Berkshire becomes more appealing.
Exactly. When they are visibly redeploying capital instead of simply holding cash, it makes them look more active, more confident.
And what about other companies in their portfolio that fit that same mold?
You immediately look at a name like American Express, ticker AXP. It's a long-time Berkshire holding that fits that same quality, cash-generative profile investors are looking for today.
Right, that durable brand.
Yeah, it has that classic moat.
Okay, that makes sense. Moving to the third group of winners, AI infrastructure and the data center ecosystem. A renewed focus on Alphabet's growth and AI spending, well, it keeps a spotlight on the hardware and the infrastructure that supports all this hyperscale computing.
The analysis here points directly to NVIDIA, ticker NVDA,
The chipmaker.
the key supplier of GPUs, yeah. They're essential for the AI workloads used by hyperscalers, like Alphabet. So more spending from Google means more demand for NVIDIA.
And then there's the physical layer, the actual buildings.
Absolutely. Look at Equinix, ticker EQIX. It's a data center REIT.
Right.
They benefit from the ongoing demand for cloud capacity and interconnection services. It's a direct infrastructure play on Alphabet's growth.
All right, so on the other side of the trade, there are three groups facing some downward pressure. This is either because of the visible sales or just the rotation away from their sectors.
Let's start with the first category, what we could call the trimmed Berkshire giants. Berkshire's continued selling of these names can be interpreted as a view that maybe the upside potential is now a bit more constrained.
And the first name here is Apple, ticker AAPL. Now, it's still their largest position by far, but a meaningful reduction can curb some of the immediate enthusiasm for the stock.
It definitely can. And then you have Bank of America, ticker BAC. The ongoing stake cuts there might lead some investors to, reconsider their exposure to large banks in general.
And that leads directly into the second category of losers, doesn't it? The big U.S. money center banks.
It does. When Berkshire reduces a flagship bank holding, the sentiment often pressures the whole large financial sector. especially with the current macro uncertainties.
So even a bellwether like JP Morgan Chase could be affected.
Yes, JPM. It's a sector leader that might lag if investment capital shifts toward technology and AI instead of financials.
And then there are others, like Citigroup, ticker C.
Right. Citigroup is a bank that's a bit more cyclical, more globally exposed. That makes it more sensitive to selling pressure if investors become cautious on the whole sector.
Okay, now for the third category, which is maybe the most direct signal of all.
Home builders and rate-sensitive cyclicals.
And this wasn't a trim. This category saw a complete exit.
That's the key. Berkshire fully sold its stake in D.R. Horton. This hints that they may see a less appealing risk-reward profile in U.S. housing.
Especially after its strong performance and with sustained higher interest rates.
Exactly.
So D.R. Horton, that's ticker DHI, loses Berkshire as a shareholder, which removes a kind of psychological support for the stock.
It does. And that concern can spread. Another large builder, like Lennar, ticker LEN, can be affected by renewed worries about housing demand and rising mortgage costs.
So to sum it all up, what we're really seeing from this filing is a clear rotation of capital. It seems to prioritize major AI and cloud platforms,
while showing increased caution regarding housing and certain financial giants.
It illustrates a move away from rate-sensitive sectors and toward durable growth compounders, specifically in the technology space.
Yes, that's a good way to put it.
Before we go, a very important note for you listening. This information is purely an analysis of the reported filings and market observations based on that information.
That's right. This is not financial advice, and these comments should not be considered buy or sell recommendations. This is purely the opinion of the author of the analysis we reviewed.
And here is a final thought for you to consider.
How does the clear exit from housing, specifically D.R. Horton, inform your understanding of the broader economic outlook for U.S. consumer sensitivity over the next year? It's something to think about.